Uh, just before you start, there was some casual conversation. Can we have?
Sure.
How is the situation in the US, Professor Pat?
The situation is improving. If you're talking about with respect to COVID-19,
Yes, yes.
yeah, it's improving slowly, but gradually, but slowly. And that's all I can say about that, because the number of cases has leveled off, hospitalization has peaked, and number of deaths, most importantly, has been going down. In spite of how crazy we are over here sometimes. But things are looking much better.
Because it was horrible. I mean, I remember when you were here in India 2 years ago.
Yes.
You were not even sure about catching the flight.
Exactly.
So
and I made it just in time. The
Yeah.
day after I left was when there was a lockdown.
Yeah, Professor Pat, I think you took the last flight to US and in 2000, you remember? So it was
2020.
2020, yes. Yeah, 2020. So
Just
it was
before the
13th.
lockdown.
It was 13th or 15th of March
Around
when you
there.
returned. When
Around
you
that
returned
time.
back. Yeah.
Mhm.
So, but definitely the last flight from Hyderabad.
Yes, the last flight out of, I flew out of Delhi.
Delhi, yeah. Hyderabad to
Yeah.
Delhi, Delhi to.
Yeah, then Delhi back home.
Yeah.
So hopefully this situation will come to an end eventually, and so we can all start doing things the normal way.
But you never know. We are witnessing waves after waves.
Yeah, unfortunately.
Yeah, there is, third wave in India, and we are witnessing hundreds of thousands of cases every day.
So, but more and more people are getting fully vaccinated, right?
Yes. See, I think this Omicron variant, this is spreading fast, but not very fatal.
Yes.
So
That's
infectious, but not fatal.
true.
That is the only, kind of security we can feel as of now.
Yes. So hopefully it doesn't get more serious.
Yeah, we'll start for the benefit of the delegates. It's 9 now. We'll be starting in the next 30 seconds.
Sure.
Yeah, good morning. Very good morning to all the delegates, and good evening to Professor Pat. It's nice to hear from you again after a couple of years now. And welcome the delegates for this very important session on contemporary research in the area of finance. Let me have the privilege of introducing Professor Pat Obi. Professor Pat Obi is an endowed professor at Purdue University Northwest with the title of White Lodging Professor of Finance. He received his PhD in Finance and Econometrics from University of Mississippi and is a certified hotel industry analyst. Currently, he is the director of the Executive MBA program of Purdue University Northwest, where he also teaches corporate finance, financial derivatives, and business analytics. In addition to serving on the board of local organizations in Chicago, Professor Obi also consults for business and local governments in the United States on matters relating to valuation, financial planning, and financial performance. He conducts regular financial workshops in community centers and businesses, especially for the hospitality industry. At various points of time, beginning in 1995, where he has served as visiting scholar to a number of overseas universities. You can check the profile actually, and I'm unable to spell, but some of the top universities in Lithuania, South Korea, South Africa, Thailand, Ghana, and of course, we were privileged to have him for 10 days at ICFAI Business School in March 2000. It was a very, very interesting, session. And also, he has recognized, let me tell that, he has recognized our university, and this summer we'll be working with him again. We are chalking out a plan, where we'll again interact, moving forward this summer too. So Professor Obi is, whatever personal interaction we had, he likes traveling. The scope of things in the area of research of finance is wide enough. And, some of our people had, if I last remember, they were working on ARDL models with him, when he last, left our campus to go back to US. So, all the delegates, he's available. He's quite popular on the net. I am sure he'll be sharing you his details. Please, I request some of the universities and others that, he's a very valuable, important resource. Yeah, moving forward, he's got, he's a recipient of the first Faculty Lecturer Award 2010 and an outstanding Faculty Scholar Award 2015 at Purdue University, Northwest. Teaching recognition has come from, Purdue Northwest, including, Teacher of the Year for the year 2000 and a number of teaching excellence awards in the Executive MBA program. Research awards have come from the Academy of Finance, Institute of Global Finance, Global Business and Finance, Association of Global Business, and Applied Business Research. Yeah, he's also a part of his wide publication, and also he is also on the editorial board of several journals. He's also an author of Basics of Business Finance, a Lithuanian language college textbook. And I think, most recently, he has come up with this wonderful book on We Must Change the Way We Live, which is more specific, actually. It is a general purpose book on financial, education, published by ICBF Publishing. Professor Pat, you can come in.
Thank you very much. I appreciate your kind introduction, and it's my honor and pleasure to be here with the people I love and with the university I so much cherish. You treated me so kindly, and I told you before I left that forever, this university will be a part of my life's journey in this industry. So if I can proceed and share my slide, bring it up. I, first of all, would like to welcome everyone. It's quite an audience. I appreciate that very much. And also, in particular, I thank a couple of my students and research scholars and friends who have tuned in, and also a couple of my colleagues, who are joining us. And I'm hoping that I will endeavor to break things down in ways that will be palatable for everyone. At the end of which, if there are comments, observations, questions that can further enrich this experience, I definitely would welcome that. So thanks once again. So the topic that I'm speaking on is contemporary research in the area of finance. And the outline is as follows. So I'm going to start out by providing an overview of panel data modeling as we have it in the field of finance today, and then speak to a specific use of that model in the field of, in the area of difference and differences modeling, which I'm hoping you'll enjoy and probably find good reason to employ it in one or more of your research endeavors. And then I will speak about time series models, specifically error correction models and some of the recent advances in that field. And then segue into panel vector auto regression as the grand finale of this presentation, and make mention of some of the emerging researchable issues. So with panel data studies, this is basically, for the most part, how financial research has grown over the years. Because as you know, it's primarily cross-sectional data on account of the underlying theory of the firm. And then we realize that we can enrich our understanding of how firms operate to create and maximize value. And then it blossomed into panel data studies. And so to a large extent, with asset pricing models, starting out with the 1964 seminal work by William Sharpe, and continuing into the first empirical examination of CAPM by Fiamma Macbeth in 1973, and continuing on, and that, ignoring the contributions made by Roland Ross in the field of APT that didn't really catch steam on account of the fact that it could never be utilized practically, we moved into Farmer-French 93. And Farmer-French 93 upsized the single factor model of Fermat-Macbeth by including size and value risk premiums, making it a 3-factor model. And then subsequently in 97, Carhart introduced 4-factor model, including a momentum risk variable that catches the difference in winner and loser stocks. However, still, we've continued to have issues with the misspecification of this fundamental model, which has been examined on a cross-sectional basis and on a panel data basis. And so more recently in 2004, Farmer-French wrote their thesis on the capital asset pricing model theory and evidence, showing that in spite of these recent advances, that the model has continued to be misspecified, where theory and empirics and practice have not converged. And then most recently is the Farmer-French 5-factor model, which in addition to the 4 factors, they have now included a risk premium that addresses the difference in returns between conservative and aggressive portfolios. So this is the current state of the art in terms of the use of panel data to examine the effort to address the risk and return relationships in order to maximize return and or minimize risk. What might be in the offing in the years to come? Well, a couple of times, you would be at a conference and someone might introduce a sustainability factor. Some have included a risk premium addressing difference in returns between conventional banking and Islamic banking. And there might, I suspect, be risk premium or premiums, if you like, that might address innovations such as artificial intelligence, virtual reality, augmented reality, machine learning, robotics, blockchain, to name a few. And so the field continues to grow, and the underlying model continues to be panel data. So in utilizing panel data, we begin by understanding that the nature requires for us to recognize both time series and cross-sectional in a longitudinal sense, right? And so in this empirical analysis that I conducted here, I sought to examine the relationship between market capitalization, which is a measure of the market value of the equity of a firm, with respect to the firm's capital expenditure, a proxy for capital expansion, and book value of equity, which is how much investments that stockholders have made in the firm. And so when I run this regression, I find interesting outcome. And of course, when we run a regression, the first port of call is to look at the F statistic to be sure that the model is statistically significant, which it is. And then we then proceed to examine the size and sign of the coefficients to see if in fact they conform to our expectations. And so in this analysis, we find that capital expansion has a positive impact on market value, which stands to reason we would expect that firms that invest more in expanding their capital as part of value-based management would increase the value of the firm. And for good measure, it is statistically significant looking at the p-value right here, which is virtually 0. The same applies to book value of equity, which has a negative coefficient. Does it make sense? Of course it does make sense, because according to the signaling hypothesis, the issue of equity carries a negative signal because it indicates a dilution of the shares for those who currently own the firm. And so we expect it to have a negative sign, which it does, and it is also statistically significant. And so we say, well, what's the problem with this? And the answer is, the problem is we can't trust these coefficients. They are probably very biased and certainly are going to be very inconsistent. Why? Because of the problem of indigeneity in the variable, as I outlined right here. The reason being that the use of panel data is inclusive of firms, as in this example, or groups or countries or whatever the subjects are, with different characteristics. And when we lump them together to carry out a regression of this nature, all those individual idiosyncratic behaviors of these firms are going to be subsumed in the error term. And so the error term is not going to be white noise. And therefore, we say, what can we do? We say, well, we can improve it by employing a fixed effects or random effects model. And so in this fixed effects model, which should serve as an improvement, what it does is to identify the heterogeneity risk error term, which is this omega term right here, and then ensure that each firm within the data set is represented by its own distinct intercept, which will tell us in particular how different the firm's market capitalization relates to these two variables. And so this is definitely an improvement because it does assume that we have indigeneity and then resolves it by using a dummy variable or a mean or a d-mean approach. Those of you who do panel data studies, I'm sure you know where that is headed. Now, though, so the question, though, that we face is, what if we have an aspect of zero correlation in the data set or even heterogeneity? In that case, we have to venture into the territory of random effects modeling to see whether there's an improvement in the sense that the estimates we obtain will be a lot more consistent, that zero correlation has been accounted for. In a nutshell, what random effects model does is to reinsert the heterogeneity term, the firm specific error term omega back into the error term. And then it would assume that this error term associated with each firm I is measuring the random deviation of each firm's intercept from the common intercept. So this time all firms are going to have a common intercept. And omega will now explain to us how different each firm randomly flows away from there. And the reason is that the random effects model assumes that the sample with which we work represents keyword random sample from a much larger underlying population. Having done this, what do? We say, well, let's be sure that this random effects model is better than fixed effects. So the result you see here on the right side is my random effects output, which preserves the signs and the statistical significance. But do we go with this or do we go with fixed effects? And the answer is we do a Hausman test. And Hausman test will tell you which way to go. If the null hypothesis is not rejected, then we stay with random effects. If it's rejected, then we go and use the fixed effects. And as you can see right here, what it does is to introduce a feasible GLS parameter, this lambda right here. If lambda is 0, then this model converges to pooled OLS, telling us that there's not much heterogeneity problem. And so the original results we got from OLS should be used. But if this lambda, this GLS parameter here is exactly equal to 1, then it tells us 1 multiplied by the mean will still give us the mean, all right, in all cases. And so what this converges to be is the d-mean fixed effects model, which we should then go back and use to make our inference. But where this GLS parameter is a value between 1 and 0, then automatically the random effects model is the model to go with, because it means that zero correlation is a problem, and that the parameters that you will estimate when you implement this model would be better, would be more trusted, they would be more consistent. So that's the story. To improve, we can ascend to the generalized method of moments approach to panel data estimation. What it does is to introduce instruments that can further insert additional information about the behavior of the target variable in the way it relates to the independent variables, to the regressors. And it does also, the internal instrument that it injects is its own lag value right here, as I demonstrate right here. And now there's a couple of things. This is a more rigorous, slightly more complex field of endeavor when it comes to panel data model. And so users of the GMM approach or better know to refer to the work of Ariana and Bond in 91 and Blundell and Bond in 98. Both of these works provide us with an enriched platform within which to make a determination as to not only whether the generalized method of moments is appropriate, but also which of these two methods is more appropriate. And the reason is because it can easily be specified when you start introducing instruments within the model that may have little or nothing to do with the inquiry. So now, in what specific ways might we be able to further apply panel data modeling in empirical analysis? The example I provide here is called difference in differences, or DID, which gives us an opportunity to extend panel data modeling to event studies. And we are quite familiar with event studies. The three most widely used approach would be the mean adjusted method, the market adjusted method, and the risk adjusted method. However, the DID approach gives us an opportunity to utilize the benefits of panel data estimation in examining how the behavior of a firm or the behavior of any subject you're examining differs after an intervention has taken place. And all of this follows the seminal work by Ashenfelter and Card in 1985. And two important empirical applications are noted here by Briss and his co-authors in 2009, and much more recently by Platt in 2018. In the initial study published in the Prestigious Review of Financial Studies, Briss and his co-authors examined how the value of firms in the European Union changed, if it did, following the introduction of the euro. And in the 2018 studies, using the same DID approach, Platt examined how the performance of firms in the former Eastern Bloc countries in Europe changed after their accession to the European Monetary Union. And it's quite interesting, the motivation behind this concept. And that's illustrated right here. So let's say that this black line ascending from left to right shows the performance of a firm. And as we can see, the performance of this firm is going up over the period. And as a result, as you can see, at this point, we have an intervention. It could have been the introduction and the announcement of a new interest rate policy, or some national or a pandemic which has just occurred, or something of significance. Now though, observe that after this incident, after this intervention has occurred, that the trend line still continues to go up, up, and up. Now, the question we have to ask is this continuing trend right here as a result of this intervention or a continuation of what was going on before? So we want to make sure that this red is telling us something distinct with respect to this intervention right here. And that's why this question here is posed. How do we know if the post-event performance, the red line, is due to the intervention right here, or simply a continuation of previous trend? And the way to operationalize this is to have a treatment group and a control group. In the sciences, they would call the treatment group the experimental group. And then this is, of course, a control group, like the group to whom you would administer placebo. And we shall observe whether the manner in which they are different prior to the intervention is still the same after the intervention. If it's the same after the intervention, then the intervention makes no difference. But if it's different, then the differential performance in the post-event period will tell us that indeed the intervention made a difference. So pursuant to that, this is the model that I introduced to you, that can be utilized to examine if, in fact, that intervention that occurs right here makes a difference in this blue broken line afterward. So in this specification, D1, as you can see here, indicates there is a dummy variable marking the post-event period, while D2 is a dummy variable that represents the treatment group. The interaction variable right here, the product of D1 and D2, is what we're going to have to look at, and in particular, the coefficient of it, which is a measure right down here of the impact of that intervention. So my contribution in this field of inquiry is summarized right here. I'm currently conducting a study on the effects of interest rate regime change on bank performance, and with a couple of colleagues, and also in another collaborative study, which is currently under review in tourism economics. We asked how much did COVID-19 affect the tourism sector. As we know, the tourism sector is at the forefront of the horrendous impact of COVID-19, and we want to examine the differential impact on that sector vis-a-vis other economic sectors. Now then, the second aspect of research area deals with error correction studies. And so this is purely time series in nature, engineered by the seminal work of Engel and Granger in 1985. And in this line of inquiry, we begin by addressing the stationarity behavior of the time series variable. Time series variable is a variable that changes over time. If you want to look at the Tobin skew of firms over the past 40 years, you want to look at the market value of firms over the past 25 years, interest rates, exchange rates, any type of financial or economic variable, indeed any kind of variable that changes with time would be a time series. And of course, in finance, the word series is both singular and plural and refers to the variable. And so the first thing we do in time series modeling for research purposes is to test the stationarity of the variable to see whether that variable is stationary at level or not. And the reason we do this is to be careful to ensure we're not running a regression of time series variables that are simply looking like they have a relationship when in fact it's just spurious. Spurious correlation or relationship is a case where two things may be moving in the same direction or in definite opposite directions, and you think that there is some underlying relationship, but in fact there isn't. So to be sure, we perform unit truth tests. And if we conduct a unit truth test and we find that those variables are stationary at level, we can run a regression with those variables. But the regression we run right here is going to be a long run model. Otherwise, if the series are not stationary at level, we difference them and then test stationarity again to see if after first difference, this delta here means first difference. After first difference, they are now stationary. And if they are, we can run a regression on the difference data, but the regression we run is short run. Thirdly, suppose that the variables are stationary after first differencing, and we say that they are I1, meaning integrated of the first order. That means stationary after first difference. If we find that to be the case, we can see if in fact they are co-integrated, meaning if they do have a long run relationship after all. And if we find that to be the case, then we implement an error correction. And therefore, if we have I1 variables, meaning variables that are integrated of the first order, meaning variables that are stationary after we difference them one time, we can implement the Engel and Granger model to see if, in addition to the blue inquiry right here, we also have the red. The whole model is what we call error correction model that enables us to examine the dynamic behavior of these co-integrated series, X and Y, where the coefficient of this error correction term will tell us how quickly the series move back together if they move apart in the short run. But you see, though, going back here, this model allows only variables that are integrated of the first order. But if we have mixed integration, some are integrated at level, some are integrated after the first difference, Pesaran, Shin, and Smith provides us with a model with which we can still examine the co-integration behavior. And we call this model the autoregressive distributed lag co-integration model, which is a derivation of the autoregressive distributed lag that is pretty ancient in the field of econometrics. So the autoregressive distributed lag is what you see in blue right here. Autoregressive means that we have lags of the dependent variable, YT minus all the lags. And distributed lag means we have lags of the independence, the explanatory variable X right here. But then when we include this red specification, we now are within the territory of the co-integration model within that umbrella of ARDL, courtesy of Pesaran, Shin, and Smith. And we are still able, using this model, which is actually a type of unrestricted error correction, still ascertain whether these variables still move together or not in the long run. And finally, we can also determine if the magnitude of impact when X increases on Y is the same as the magnitude of impact on Y when X decreases. If the magnitude of impact is different when X goes up versus when it goes down, then we're within the territory of nonlinear autoregressive distributed lag right up here. And so, as in yesterday's opening keynote, we found that the issue before monetary authorities right now is how to balance the impact of money supply so as to make sure that economies grow without creating inflationary pressures. So maybe an inquiry that one might could examine within this framework is to determine whether when interest rates go up and it affects corporate valuation, does it affect corporate valuation in the same way, of the same magnitude as when interest rates go down? If the answer is no, then that's an asymmetric relationship, and the model would be this asymmetric error correction model. So this is a pretty unparalleled approach in the way we examine the time series dynamics of variables that may or may not be integrated of the first or zero order. This model does not admit variables that are integrated of the second order or higher. And so some recent applications in the financial literature and others are summarized right here. And these are quite recent. So in the first study, the examination is between oil prices and stock prices of clean energy firms. In the second one right here, it deals with energy consumption and growth in India. In the third one, it deals with gold futures prices and inflation. And then this final one, it deals with interest rate changes and its relationship with the deposit rate in financial institutions, I believe in Taiwan. So in my own case, there is an age-old inquiry as to whether tourism has any kind of sustainable relationship with economic growth. Many studies have shown that to be the case in many economies, large and small. None yet for the United States, except when US data are included in a panel data set. But on its own, no study has yet been able to tackle that question for a variety of reasons, which I can't get into right here. But if I were to examine this tourism growth dynamic for the U.S. economy, the model would look something like this, where I could use tourist arrivals and as a measure of tourism and examine that in relationship with GDP, a measure of economic growth. And in fact, I did that and confirmed, as did many studies, that there is no co-integration, no long-run relationship. And then I started to dig the literature and determined that there are mediating variables such as risk, measured perhaps by implied volatility, and exchange rates. And so in a study that will soon appear in the Journal of Risk and Financial Management, right here, summarized right here, we examine the mediating effects of implied volatility and exchange rates on that relationship, on the US tourism growth nexus. And so the target variables here is going to be tourism development variables, and of course, real GDP. And then the mediating variables here are going to be exchange rate, which is a measure of currency valuation, something that can influence your choice of a destination because you want to travel to where you can get a good return on your money. And implied volatility, which is a measure of investor fear gauge in the equity market, telling us how afraid we are or not so afraid we are of the future. Obviously, as a tourist, you take that into account. The type of instability that could be that could occur in the place that you might want to travel will influence when you want to go there, how long you're going to stay there, how much money you're going to spend, and in fact, if you will go there at all. And for anyone who is not affected by COVID-19 with respect to tourism, I think that person would have come from a different planet. Anyhow, this would be the model that would be utilized. A little bit extensive, but very robust in addressing the mediating factors summarized by the vector that you see right here, X, in both the short term in blue and the long-term components of the nonlinear autoregressive distributed lag. And our results are quite interesting. And more recently, with my good friend Munawar, who is also connected here, a PhD scholar and his PhD advisor, we have sought to examine the behavior, the interrelationship between equity and bond markets using the same model over the course of the pandemic. And we found some pretty interesting results. So the next is panel vector autoregression, which now allows us the opportunity to combine the best of time series analysis in error correction form and panel data. And so the question is, how do we best proceed with this? Because this has a little bit more aspects to it than a regular time series inquiry. Again, we're going to have to do a unit root test. And if we find reason in the sense that the variables are integrated in the first order, then we do a panel co-integration test. And depending on the outcome, we might proceed with a panel VAR, which would be the case where the variables are integrated of the first order, but they are not co-integrated, meaning they have no long-run relationship. Or we could continue into panel vector error correction model in the case where the variables are integrated of the first order and also co-integrated. And of course, if we determine that the variables are a mix of I0 and I1, then of course a panel ARDL, which is the most robust, would be utilized. And so I show this, but how an example of this, but all grounded on this motivation right here. So this is a recent publication by the United Nations World Tourism Organization, which reinforces how it is, the fact that tourism is the largest single economic sector and industry actually globally. employing over 10% of the global workforce, and providing opportunities of employment and sustainable income, in particular to young people and to women. About 54% of people in this industry are women. And this has transformed many young economies that probably would have still been in a third world phase into middle income countries. Many of them are in the Caribbean and some in Southeast Asia, all on account of tourism. And so the data that you see right here, which is the most recent data for 2019, all right, published in 2020, is one that shows one of the three metrics published by the UNWTO as a tourism development indicator. And this is showing how much surplus these countries are generating from tourism. So tourism surplus represents how much more money these countries are making from tourism over and above how much their citizens are spending when they travel out. And you can see that at the very top of the food chain is the US, with over $62 billion in the most recent period. A close second is Spain. Then look at Thailand, Turkey, Japan, Italy, going down. India makes the top 20, as you can see down here also. But additionally, tourist arrivals and tourism receipts represent additional measures with which to examine the economic benefit of tourism. And so a lot of studies that seek to examine the economic impact of tourism or the financial effects of tourism spending use these two metrics: tourist arrivals and tourism receipts. And the third could be tourism surplus. And you will find that a lot of the countries that makes this top 10 in terms of tourist arrivals, as well as tourist tourism receipts, also are in the top 20. So there is a sustained presence by these countries to enrich their citizens by opening their doors to international tourism and making their economies large and robust enough to grow the middle class. So on account of that, the current study, as I approach the finale of this, examines the relationship between tourism development on the left side of this functional form and market capitalization. And of course, I'm going to throw in GDP, which is a macroeconomic measure, and exchange rate, which is both a financial and economic metric. Why market capitalization? You see, in the extant literature right now, a lot of these studies use various measures of GDP and seek to understand and seek to make a determination as to whether we have what's called tourism growth, tourism-led growth, or growth-led tourism. In other words, whether tourism influences economic growth or whether economic growth influences tourism. But what I inject here is market capitalization, which, as you know, unlike GDP, market capitalization is a leading economic indicator. And so it gives us a sense as to what the plurality of the market believes would be the future direction of the economy. And on account of that, we want to know the role that tourism development plays in that dynamic. Pursuant to that, I create three large portfolios based on countries with the largest tourism surplus, countries with the top 10 tourist arrivals, and countries with the top 10 tourism receipts. And it looks like this. So this example that you see here is based on surplus. And so these are the top three from the group in the panel. And there are others. So now, what's the idea behind this in this preliminary inquiry? It's to examine the dynamics between tourism development on one hand and economic growth and market capitalization on the other hand. So I already have identified my tourism development indicators right here, receipts and arrivals, and real GDP, and market capitalization, which is going to be measured using either stock returns or changes in market capitalization. So now the task ahead of me is to determine which panel VAR model to utilize. Is it going to be a regular panel VAR modeling such as this? And the answer is yes, if I'm dealing with variables that are integrated of the first order and not co-integrated. So of my variables, I find that both tourist arrivals and real GDP are integrated of the first order. However, they are not co-integrated. So the panel VAR model here, observe that we have identified, we have included the fixed effects heterogeneity term, this mu right here, SABI. And so I'm going to have two equations, one in which I examine the tourism-led growth hypothesis and the other, the growth-led tourism hypothesis. And when I examine whether tourism grandeur causes economic growth measured by GDP, I find that to be true. I find that F is quite high, it's very significant. I find in particular that these coefficients for tourism right here all have statistically significant coefficients. Look at their p-values. They're all less than 5%. And if I test jointly these coefficients that you see right here, which is what you see on the right side of this slide, you'll see here that the p-value, which tests their coefficients right here, are all 0, telling us at the 5% level, in fact, at any conventional level, we reject this null hypothesis of no short-run causality in favor of the alternative that there is short-run causality running from tourism development to GDP. Reverse causality also shows the same thing. So we also have the case where GDP grandeur causes tourism, because as you can see right here, the p-values are all virtually 0. And so the conclusion of this preliminary work is that when tourism development is measured using tourist arrivals, we have a bidirectional short-run grandeur causality right down here. The other is panel vector error correction model, which this would be the model. Remember, this is a restricted VAR where the long-term elements are restricted with the use of this error correction term right here. And I find that tourism receipts and market capitalization are both integrated of the first order and also co-integrated. So in this case, this would be my estimation model. And when I do that, I find that this coefficient that you see here, negative 0.064, represents the speed of adjustment to long-run equilibrium. Meaning what? Well, for those of you who do this kind of study, you understand this to be the speed of adjustment. For everyone else, what this is really telling us is that between market capitalization and tourism receipts, that every now and again in the short run, they can move away from their traditional long-run relationship. However, every period, there's a convergence toward long-run equilibrium at the rate of about 6.4% per year. Why per year? Because I'm using annual data. And you can see right down here, the value of the statistic, that this is significant. And to be sure, here's the p-value right here, 0.0002. So at the 1% level, we conclude that there is a long-run relationship, and in fact, that real GDP, that market capitalization grandeur causes tourism development. So that's the information that we get from this. Whenever the coefficient of the co-integrating equation is significant, we can conclude on two things. First, we conclude that there is a long-run grandeur causality. Second, we can determine the speed of adjustments to long-run equilibrium measured by the value of this coefficient, this 6.4%. And then separately, we can also examine if we have short-run causality. And the answer is yes, because the short run coefficients are these guys right here. The terms with D, meaning differences. And I've highlighted them here, and you can take my word for it. The Wald test of these coefficients shows that there is short run causality. And so we have both long run and short run Granger causality between running from market capitalization to tourism. So the way the stock market behaves can inform a great deal what's going to happen in the tourism industry, is one simple way to explain this. But how about reverse causality? That doesn't happen, which is an interesting finding in this preliminary study. You can see that right here, that the coefficient of long run equilibrium right here is not significant right here. And you can look at it over here. Its p-value is 0.79, about 0.8. So it's not significant. And by the way, it should also be negative, and it's not negative. So even if it were significant but positive, that wouldn't work, because it means it's not converging. And therefore, we can conclude here that there is no reverse causality. What we have here is the one-way right here in blue on the lower left corner of my screen. There's evidence only of a one-way long run and short run Granger causality from market capitalization from the stock market to tourism. And finally, panel autoregressive distributed lag modeling, which was introduced primarily by Pesaran, Sheen, and Smith in '99, and more recently has been very widely applied. And one of the studies I like is this one right here, dynamic heterogeneous panel analysis of the correlation between stock prices and exchange rates. It's a beautiful financial study that I'm sure anyone interested in this field of endeavor will find it to be very enriching. And so to do this though, what Pesaran and his co-authors explained to us in '99 is that we can actually fulfill the purpose of this analysis by using what they call pooled mean group estimator, which is the case where we assume that there's a common coefficient in the long run model right here in red. In other words, that the way the variables relate to each other in the long run across all the countries is the same. Now, though, for this model to be utilized successfully, the time period should be significant, should be large enough. Otherwise, you're not going to be able to get reliable estimates when you run the regression. Anyhow, so with this, here's my example of it. So here, I introduced a multivariate framework where tourism receipts, a measure of tourism development, is the target variable. And I'm now combining a macroeconomic variable, GDP, with market capitalization, MCAP, in the multivariate model. So when I implement the panel ARDL, I find this interesting result right here. So there are two outcomes, two interpretations that can be advanced out of this output, simple output that you see right here. The first is the sign of this coefficient of the co-integrating equation, right? So I use e-views in all these respects. Sign needs to be negative for it to have economic interpretation. Remember, negative means it converges. Second, it needs to be statistically significant, which it is at the 5%, even at the 1% level. Thirdly, by it being significant and possessing the correct sign, we are able to conclude that these variables, GDP and market capitalization right here, these two regressors right here, that they jointly Granger cause tourism. In other words, tourism development is influenced jointly by the overall economy and also by events, by innovations in the stock market. And then the other aspect of interpretation is with respect to short-run causality. The short-run aspect of this output is summarized by these two coefficients right here for GDP and for MCAP, which, as you can see, they are not quite significant. And so I summarize right here in the last two bullets right here that GDP has positive impact. It does, because you can see that this coefficient 1.025 is positive. So it does have positive impact on tourism, TR, although not significant at the 5% level. It's only weakly significant at the 10% level. Look at the p-value, only 0.077. But MCAP, look at MCAP over here. It has no short-run impact. And the reason is because its p-value is much greater than 5%. And so in all, we find evidence of long-run causality, but not short-run causality when those three variables are examined in concert. And so what are some of the emerging researchable issues? I summarized them. I think going forward, you would agree with me that a great deal will be written and said about COVID-19, blockchain, cryptocurrencies, fintech, financial inclusion, especially in the developing economies, and beyond, actually, sustainability and green finance in this age, right? Environmental impact studies, crowdfunding and social enterprise, and also behavioral finance, especially after the Nobel Prize that was received on account of his studies on behavioral finance some 5 years ago by the professor from University of Chicago, showing that strict adherence to the financial aspects, to the financial drivers can be misleading. There are many investors that make choices outside of the pecuniary factors, outside of the money factor. Sometimes you may see someone investing in green energy companies, not because there's a lot of money to be made, but because that's where his or her personal philosophy or a way of life, that's where he or she is aligned. And they want to promote that sector of the economy. So I'm done with my presentation. And for those of you who know me, you're familiar with my social media presence. For everyone else, I'm quite out there in the social media. I have a pretty robust YouTube channel with over 200 pieces of videos with 14,000 subscribers. I'm also on Facebook. Feel free to connect with me in that respect, and also on Instagram and Twitter. And so I urge you to catch up with me in these media. My YouTube channel is the most active, where my videos on various aspects of finance, statistics, and financial econometrics are posted, and they will soon be updated with some of these more recent demonstrations of panel VAR. And so I thank all of you for being here and for listening to my boring presentation. All right. Thank you very much. And that's it. Any questions or comments would be very welcome.
Yeah, Professor Satish, we'll take in one or two questions because we are nearing our this one question or two.
Sure. I apologize. It took a little time.
I know we thoroughly enjoyed it. Yeah, anyone would like to ask any question? We have 1 or 2 minutes.
So it was quite an interesting session.
Thank you.
Sir, I have a question here. This is Professor Abhishek. Cryptocurrency on one hand, the investment industry is not ready to accept it, and there are practical reasons for that. On the other hand, because they have existed for such a long time, we are thinking about researching on this. Secondly, behavioral finance, we have already proved that it exists, and we can't do much about it. So are we really adding any practical relevance if we continue researching on these two topics? This is a thought that I have.
Yeah, and I think that is definitely a good point to note. I think behavioral finance, it's been proven to exist. However, my view of it, I'm not in that field of research at all, but I think that we have to be careful to not assume that behavioral finance is a one-size-fits-all. We might want to investigate perhaps whether the same drivers in behavioral finance exist in different demographies. For example, the way that men in a particular society might consider the value of an investment may not be the same way that women might, may not be the same way that people from different ethnicities might, maybe from different countries, from different income groups, etc. So my suspicion is that what moves you may not be what moves your neighbor. Behavioral finance has complexity, as complex as human behavior. What moves you this year may not move you next year. So I wonder if, in fact, there are other aspects to pursue, because it's an inquiry in market efficiency. Behavioral finance is that indicator is saying that the market is actually not as efficient as we expect it to be on account of that human behavior, even if security prices, even if assets are priced in the absence of it. That's my view of it. But with respect to the other point, it's well taken. I think, this is the beauty of research, right? So people must want to address issues that are compelling and current from their standpoint. I think that's definitely important. I appreciate that.
Yeah, Professor Satish, would you like to pick up one question from the chat box?
Mm-hmm. Yeah, let's see here. So, thanks a lot, sir. Okay, thank you.
Yeah, most of them are thanking. Okay. Yeah, Professor Pat Obi, it's been wonderful. One of the important things which I always learn from, Professor Pat is, what makes a good teacher and also what makes a good researcher. When you're starting off, most of us would have thought that, he will only talk, right from the NRDL or the DID approach. But then whenever he speaks, it starts off right from the pool regression, right from stationarity, and then takes it forward. I think this is a very, very important thing for all teachers and all researchers, that, you'll have to take every particular session as a standalone entity and give the background and, before you start. And I think that is what made, Professor Pat so popular and so famous. And, he's been winning a lot or he's been awarded a lot as a teacher as well as a researcher. Second most important thing is also with regard to, the inquiry, the reason why we are using the right tool in the right place. I think, that is very, very, very important. Right? I'm sure that all of you would have learned a lot, from his experience. And, whenever he always starts from basics and, moves up. He also shows this piece of work in the current areas along with the results. I think that makes a great teacher. A lot of learning for a lot of us, and a lot of learning for a lot of researchers, not doing research for the sake of research, but actually trying to identify some of the questions or some of the issues facing our society and the industry, where we can come up with some application, or what you call in terms of some ways in which you can find out what is the reason for this issue. Thank you very much, Professor Pat. As always, we'll get back to you this summer. And namaste. And it was a great learning. And I do hope that other universities and the research scholars from other places do invite him. He's very active. Please feel free to have a look at his YouTube and then connect with him. All the researchers is working worldwide with a lot of research scholars, as with our own Mr. Munawar. So I wish you, sir, all the best. Thank you.
Thank you very much, Doctor. Thank you to all of you for your kind words. And this platform, anytime I engage with fine people such as you, it's a learning experience for me. So I am much of an audience in this forum as everyone here is. It's a symbiotic learning experience. No one knows better than the other person. And so thank you for giving me this opportunity to keep learning. All right. And let's stay in touch. All right. I wish you the very best throughout the course of this 2-day conference. Thank you and Happy New Year to all of you.
Thank you. Thank you, Professor Pat. Thank you. Take care.
Thank you, sir. Thank you.
Thank you very much.
I request all the participants to please join to their respective sessions, because it's already 10. Professor Neeti.
Hi, I was just planning to leave.
Okay. In case you're busy, you can leave. I'm sorry we couldn't talk much.
No. I'm sorry. I didn't want to barge in, but Pat is my colleague. I am a professor in the physics department.
Okay,
So,
okay.
Even though we have very little overlap, but I am the appointed liaison with any Indian institution and the university by the chancellor. So I was very keen to listen to him, and I actually wrote down in the chat that Pat is actually our superstar at the university. So I just wanted to kind of throw in there, but
So nice of you. See, there's no relation between the talk we are doing here and the kind of background you belong to. Still, you made it to attend the meeting. I mean, so nice of you. Thank you very much, madam.
Yeah, my pleasure. Thank you for letting me be there. And maybe next time I come to Hyderabad, I'll come and visit you all too.
Definitely. You are most welcome, ma'am. Please visit us.
My pleasure. Thank you so much.
Thank you. Good
Bye,
morning from
everyone.
India and good night to you, ma'am.
Yes, good night. Namaste.
Namaste, madam.
Bye.
Ah.